Have you noticed something strange? Everywhere you look, people are celebrating. Financial headlines are announcing new records. Investors are becoming increasingly confident. Social media is full of stories about easy gains. And whenever markets reach new highs, one phrase begins to dominate conversations. Maybe this time is different. But I've lived through enough cycles to know that those words deserve careful attention. Because some of the biggest mistakes in financial history were made precisely when people felt the most comfortable. What I'm about to share isn't a prediction, it's an observation. An observation based on studying market cycles, debt cycles, economic cycles, and human behavior across decades. And right now, there are patterns emerging that I've seen before. Before we go further, take a moment to like this video and subscribe to the channel. We spend a lot of time studying the forces shaping the economy, markets, and the future of wealth, so you can think more clearly about what comes next. Now let's begin. When markets hit record highs, most people assume risk is disappearing. In reality, risk is often increasing. The paradox of investing is that assets frequently feel safest when they are actually becoming most dangerous. Think about it. If everyone is optimistic, who is left to buy? If expectations are already extremely high, how much room remains for surprise? The greatest market advances often create the very conditions that eventually limit future returns. That doesn't mean a crash is imminent. It simply means investors should pay attention to what expectations are pricing in. One lesson that history repeatedly teaches is that markets move in cycles, not because economics is perfectly predictable, but because human behavior is remarkably consistent. People become excited, prices rise, success attracts attention, attention attracts money, more money pushes prices even higher, confidence grows, risk-taking expands, leverage increases, and eventually the cycle reaches a point where expectations become disconnected from reality. At that stage, the system becomes vulnerable, not because anyone knows exactly when things will change, but because there is very little margin for disappointment. I've seen versions of this before. The details were different, the industries were different, the technologies were different, the narratives were different, but the emotional patterns were almost identical. People believed opportunity was endless. People believed risks had become outdated. People believed old rules no longer applied. And every generation finds a unique way to convince itself that history has stopped mattering. History never stops mattering. One reason these cycles occur is because people focus heavily on recent experience. If markets have risen for several years, investors begin assuming they will continue rising. If volatility has remained low, investors begin assuming volatility is gone. If credit has been easy, borrowers begin assuming credit will always remain available. This tendency is natural, but it can be dangerous. The future is rarely a straight extension of the recent past. The forces driving markets are constantly evolving, and the biggest risks often emerge where confidence is highest. Today, one of the most important forces to monitor is debt. Debt is neither good nor bad by itself. Used wisely, it can accelerate growth. Used excessively, it can create fragility. Throughout history, periods of rapid asset appreciation are often accompanied by expanding debt. More borrowing fuels more spending. More spending supports higher asset prices. Higher asset prices create more confidence, and more confidence encourages additional borrowing. The cycle becomes self-reinforcing until eventually it doesn't. When debt reaches levels that cannot be comfortably serviced, the dynamic changes. Growth slows, liquidity tightens, and investors discover that leverage works both ways. This is why understanding debt matters far more than following daily headlines. Debt shapes economic outcomes. Debt influences interest rates. Debt affects asset prices. Debt determines how resilient or fragile a financial system becomes. Another signal I always watch is the relationship between prices and fundamentals. A great asset can still be a poor investment if purchased at the wrong price. This is one of the hardest lessons for investors to accept. People fall in love with stories. They become attached to narratives. They focus on what is possible. But investing ultimately involves weighing possibilities against prices. A wonderful future can already be reflected in today's valuation. And when expectations become too optimistic, even good news can disappoint investors. That's why discipline matters. Not because discipline feels good, but because discipline protects you when emotions become extreme. The most successful investors I've encountered share one common trait. They remain thoughtful when others become emotional. They ask difficult questions when everyone else is celebrating. They examine assumptions, they challenge consensus, and they never confuse confidence with certainty. This doesn't mean becoming bearish whenever markets rise. That's not the lesson. The lesson is balance. Markets can continue climbing much longer than people expect. Innovation can create enormous value. Economic growth can surprise to the upside. But intelligent investing requires respecting both opportunity and risk simultaneously. The world isn't black or white, it's probabilistic. That mindset changes everything. Instead of asking what will happen, ask what could happen. Instead of betting everything on one outcome, prepare for multiple outcomes. Instead of chasing certainty, build resilience. That's how long-term wealth is created. And more importantly, that's how long-term wealth is preserved. One of the biggest misconceptions about investing is that great investors predict the future. Most don't. They build portfolios that can survive uncertainty. They recognize that surprises are inevitable. They understand that mistakes are unavoidable. And they know that survival is the foundation of success. If you survive long enough, opportunities will continue appearing. If you don't survive, forecasts become irrelevant. That's why risk management matters so much. Unfortunately, risk management often feels unnecessary during bull markets. Everything appears easy. Returns seem effortless. Caution feels outdated. But that is precisely when risk management becomes most valuable. Insurance feels expensive until you need it. Diversification feels boring until concentration fails. Patience feels frustrating until impatience becomes costly. These principles are timeless because human nature is timeless. And when I look at today's environment, I see many familiar characteristics: strong optimism, rising confidence, growing narratives, expensive assets, and widespread belief that progress will continue uninterrupted. Perhaps it will. Perhaps markets will continue reaching even higher levels. But history suggests that periods of maximum confidence deserve maximum attention. Not fear, attention. There's a difference. Fear leads to poor decisions. Attention leads to better decisions. The goal isn't to predict disaster. The goal is to understand reality. And reality is that every cycle eventually changes. Every boom eventually cools. Every trend eventually encounters resistance. Every generation eventually learns that markets move in both directions. The investors who thrive are not those who predict every turning point. They are the ones who remain adaptable. They are the ones who recognize changing conditions. They are the ones who prepare before preparation becomes popular. If there is one message I hope you take from this discussion, it's this: record highs are not inherently dangerous, but they are moments that deserve deeper thinking, because success can create complacency, and complacency can create vulnerability. The smartest investors understand that prosperity and caution can coexist. Optimism and discipline can coexist. Opportunity and risk can coexist. In fact, they usually do. The future will almost certainly contain surprises. It always does. The question is whether you'll be prepared when they arrive. And preparation begins with understanding the cycle you're living through today. Thank you for watching. If you found value in this discussion, make sure to like the video, subscribe to the channel, and share it with someone who wants to better understand how markets really work. Remember, don't focus on what everyone is talking about today. Focus on the forces that will still matter tomorrow. That's where the biggest opportunities and the biggest lessons are usually found.